Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance.
Hello and welcome to another episode of the Wall Street Lab podcast. My name is Leo Severino, and it's been quite some time since I've recorded an interview for you guys, so I apologize for having been gone for a while. But I know that Andy has kept you guys entertained and brought you some great guests over the last few months. But now that I'm back, I am really excited to bring you this next guest. If you are an allocator and are interested in learning more about how the best in the business go about vetting their private equity managers, you might want to stick around for this one. I had the great pleasure to speak to Christopher Schelling, the director responsible for private equity investments at Texas Municipal Retirement System, or TMRS. And aside from being a well-known columnist for Institutional Investor and a guy that makes his passion for the profession very evident, Chris takes quite a scientific approach to manager selection. We start the interview by going through the due diligence process at TMRS. We cover topics such as the right use of credit facilities, breaking down sources of returns of private equity managers, and then we get very specific about how Chris and his colleagues evaluate the 4 Ps of manager selection, and arguably the most important of them all, the people. Chris wrote a great article about this topic on Chief Investment Officer, and it's actually the reason why I contacted him. The name of the article is Psyching Out Money Managers, which I highly recommend for everyone to check out as background for this conversation. And at the very end, Chris talks about careers as an allocator and what it takes to excel in this field of finance. I learned quite a bit from this conversation, and if you have been able to learn a thing or two from this episode, I would appreciate it if you could leave us a review on iTunes or Apple Podcasts or wherever they call it these days, or whatever platform you are listening to this episode from. So now, without further ado, please enjoy my conversation with Christopher Schelling. Hello, Chris. Thank you very much for being here at the Wall Street Lab. It's a true pleasure to have you on. I guess for those of us who don't know you, maybe we should start with a little bit of your background, and you can go from there.
Sure. Thanks for having me, Leo. It's a pleasure to be here. So I'm Chris Schelling. I'm the director of private equity at Texas Municipal Retirement Systems. We're a $30 billion pension across the state of Texas, headquartered in Austin. I run private equity, which is about a 5% target, and we've committed about $2.5 billion in the 5 years that I've been here. Prior to joining Texas Municipal, I was the Deputy Chief Investment Officer at Kentucky Retirement Systems, where I had de facto responsibility for the alts portfolio, which was about 35% of the plan, about $5.5 billion.
So I read in your background that you focused on absolute return strategies before, and now you're a director of private equity. So what was that change like, and why did you decide to move to the private side?
Sure, I'll walk through the transition a little bit more. So at Kentucky, I, as I mentioned, had kind of responsibility for the whole alternatives portfolio, but had more hands-on involvement in building the hedge fund and real asset book there. Mm-hmm. So I was there for about 3.5 years, and immediately prior to that had been at Mercer Investment Consulting in a manager research role where I focused on hedge funds and did some hybrid private credit. Mm-hmm. And so at Kentucky, the opportunity to join there, it was compelling to do hedge funds with a de novo portfolio, but also sort of learn about real assets, which is a broader mandate. And a lot of what we did had some credit kind of component to it, lending against real assets, but those were a lot of drawdown vehicles or private equity structured vehicles. Moving down to Texas Municipal was an opportunity, I thought, to sort of fill out that third leg in terms of an alts vertical. So PE, real assets, and hedge funds. Mm-hmm. But importantly, I followed our chief investment officer at Kentucky Retirement System, TJ Carlson. He was the CIO there. He came down here to Texas Municipal about a year prior to me joining. So I had a chance to follow an investor that I'd worked with, had a good relationship with, and had a lot of respect for. So coming here to build out the PE book from scratch, again, a de novo opportunity, was very compelling.
And what is it that you took from Kentucky to Texas in terms of maybe lessons that you learned or mistakes that you made there that you try to prevent from happening now in Texas?
Well, no real enormous insights there, just always a focus on kind of minimizing risk and trying to get better. So our due diligence process that we implemented here followed kind of naturally from what we had been doing there. I would say we have kind of an overarching philosophy on people, process, portfolio, and performance. I'd say the more time we've spent working with drawdown structured vehicles as a team, the more and more important it became important to focus on the people component and getting to know them. You're locked up in these funds for, 10 years. You have recourse in some cases to remove the GP, but by and large, you're kind of stuck with them. You got to get it right on the way in. We did have a legacy position that we inherited at Kentucky Retirement Systems that wound up being a fraud. It was a venture fund in the portfolio. And so we had some experience with having to use no fault removal clause to kick the GP out, freeze some of the assets, bring in a restructuring GP, create some liquidity from the portfolio so that they could get paid and then manage the assets. And so that was kind of a learning experience, I'd say.
Yeah. One that you hope will not repeat.
Yeah, hopefully won't repeat. And certainly we've done everything possible so that it doesn't on our watch.
Right. Yeah. So before we get into due diligence and the importance of focusing on people, as you mentioned, and you've written extensively about this, what does a portfolio look like, TMRS, in terms of asset allocation? You said 5% private equity. What do the other asset classes look like?
So we're similar in terms of our portfolio construction as we were at Kentucky Retirement Systems. I'd say broadly speaking, it's roughly 35% alternatives and 65% public markets. It's kind of spread out a little bit differently, but you can think of the public markets as essentially 35% in public equities, roughly 30% in fixed income. That's a mix of kind of core and credit strategies. And then on the private market side, there's 10% allocation to real assets. There's some public stuff in there as well. There's 10% to real estate. We have 10% in hedge funds. And I said PEs is 5%, but we're sort of growing it to get there because it's only 5 years old. So assets in the ground, it's about 3% today. So the numbers won't exactly add up to 100 because we've got some public stuff in the real asset portfolio, and we got a little overweight to equities actually as we continue to fund PE.
Okay, that makes sense. And I read that you were the leading force in standardizing the DD process at TMRS. So I'm curious to hear what that process looks like. So maybe you can walk us through how you source managers first, and then what is it exactly that you look at? And I'm sure there'll be questions coming up after that.
Sure. Yeah. So as I mentioned, we came down from Kentucky Retirement Systems. Our CIO joined here because it was an opportunity to build out sort of a bigger plan, a little bit better funded situation to build out alternatives again, kind of from scratch. And so when we got here, there's no credit, no private equity, no private real assets, and essentially no hedge funds. There was some legacy real estate, and the real estate portfolio sort of has been built out more since then, but they had a head start there. And then there was one large fund-to-fund relationship that got us exposure in hedge funds, but over 5 years, that's gone from all fund-to-fund to essentially all direct. So we really had, a new team in place. We had new mandates to go and commit capital. Over the last 5 years now, it's probably been about nearly $10 billion worth of total commitments across everything. So we've been very busy. And I'd say we were also fortunate to get a really strong team kind of day one. So we brought in another colleague from Kentucky Retirement Systems, Tom Mastay, who worked with all its portfolio there and had experience in private equity and real assets. He joined us as our director of real assets and real estate. And we brought on our head of hedge funds from Texas, the permanent fund here in town, Mark Levitt, who built hedge funds. So the three of us literally joined within a couple weeks of each other, sat down to sort of collaborate from the beginning. So there was a lot of interaction across teams. Everybody had kind of multi-alts experience. We really shared the same sort of approach to due diligence. I would say we do rely on, as far as walking through the process, we do rely heavily on consultants because we're still kind of a lean team. That's a big portfolio. And frankly, our board also requires that, additional opinion on everything that we're doing. And so we work with Allborn in hedge funds, and we work with Stepstone in private equity. And I would say, so if we start at the top of the funnel, sourcing, that's a huge component of our jobs. Our analysts are taking multiple meetings pretty much every day. I'd say private equity, we look at 500 decks a year. We take around 250 to 300 meetings annually. Mm-hmm. We do 50 to 60 sort of on-sites, and we recommend 10 managers. So it gets kind of at the bottom, but it's a wide aperture at the top. And I think that's important, to see as many funds as you can. Now, all those 500, a lot of them do come from, StepStone's sourcing funnel. And so there's obviously a ton of overlap, but we have an open door policy. We do see manager flow that's a little bit outside of their funnel, and Austin being, sort of the center of public plan allocators in Texas. There's Texas Teachers, Permanent Fund, UTIMCO, County and District, Texas ERS, et cetera. There's a lot of manager flow through town. So we're very active at the top of the funnel, turning over as many stones as we can.
Mm-hmm. I just had a follow-up to this because 500 managers in one, you said, and only on the alternative side, right?
That's just the PE. So in
only
hedge
PE.
funds,
Wow.
We're seeing the same flow in hedge funds, the same flow in private credit, and the same flow in real assets. So we're taking, as an alts team, close to 2,000 meetings a year.
That is a crazy number. And I wonder, there are allocators who, try to read everything the manager has ever written and spends 10 hours sorting through documents before the first meeting. And there are others that just take meetings and see if the first meeting is a good one, then they go on and spend time digging for that. What approach do you take internally?
Well, obviously, given the volume, we're willing to take more initial meetings. Now, we try to be somewhat reasonable in terms of our time and resource allocation. So we're not taking complete flyers. There's an initial screen, and we basically need to see the deck in order to prioritize whether or not we should take that meeting. And, there's a quick screen of the tenure of the team, the caliber of the team. We're happy to do fund ones, but we want to see a team that's actually been together before. So I think of it as fund ones, but not, first-time teams.
Right.
We look for a track record, and so there's some initial kind of performance screen. If your performance in that strategy is below what our cost of capital is in that strategy, it's a quick no. It doesn't make sense to go any further. If it's at least meets that objective or better, then we'll consider it. There's no guarantee, but we look for, strategy fit with what we're looking for right now. Again, if it's not actionable for us, then we'll pass. But really, if it fits those, big picture things, then we'll take the meeting.
Mm-hmm. Okay. And what does a first meeting look like with you? Do you just let the manager speak and say what they've rehearsed 100 times, or do you take control? And what does that look like?
Well, if they're asking for our time, we expect them to have an agenda that they would like to discuss. Certainly, we're going to ask questions and try to drive to get out of it what we want. If we're asking for the meeting, conversely, then we'll try to set the agenda and go through specific topics. But if they're coming through and they send us the deck and we've got an hour, we're happy to kind of listen to what they have to say. Now, they need to tick off the right things for us to continue the conversation, and we're going to ask tough questions as that meeting goes. So they'll walk through there, and everyone, in private equity, everyone's talking proprietary deal flow. Everyone's talking about their edge and value creation. Those high level kind of buzzwords don't really matter. We're going to drill into, what do you mean by proprietary? Like, walk through actually your deal flow count, and let's look at how many of them were intermediated, what types of intermediaries were there, how many other participants were there in the first round bidding process. Like, we'll get into stuff kind of quickly and just go from there.
Okay. So let's assume the manager comes in and you like what you see. What does the process look like after that?
So then we'll engage in what we call preliminary due diligence, and that's where we're going to look to see some material. We will, again, try to stage in our resources because we're seeing high volume and we've got limited bandwidth. So we won't read everything immediately, but we're going to start reviewing stuff in your data room. We'll do more work on the track record so that, we get above the headline numbers sort of in your deck. I think StepStone has told us that if you pick the vintage year prior to or after, so you just cherry pick plus or minus 1 year, 70% of funds in Burgess could be top quartile. So there's always a story where you can say, well, we raised the fund late in the year. We didn't make the next call into the next year. So against this vintage, we're top quartile. We'll actually then start to dig in the performance to see if it justifies additional work. And if that's the case, we'll do maybe some reference calls. We'll then try to schedule an on-site.
Mm-hmm.
And then we'll start to coordinate with Stepstone, right? Like, we're not going to do a ton of work on something that they think is a terrible idea. And so we're going to use them to bring them in as additional resources.
Mm-hmm. And in private equity, how much weight do you really put in performance? Because, I mean, I think I can't recall the exact paper, but there's been some evidence of managers going into fundraising, picking a number that would put them in the first quartile or second quartile, and that number may change after fundraising is over. So how much emphasis do you really put on those numbers?
Performance is extremely important, but you have to understand what it says. You can't let the manager make it say what they want to say. You've got to interpret it. So we're going to be digging into, the actual cash flows in the fund and understand like timing around deals. And so two of the easiest ways to game IRR, I think is what you're referring to, are to use a credit facility to delay the capital call, or to sell a deal that's performing quite well early in order to pull forward cash flows and make interim performance look good while you're raising the next fund. So obviously we're aware of how managers use those tools, and we will try to dig through your actual cash flows, take out the effects of credit facilities. We'll compare returns to public market equivalents. We will even move timing around and just say, okay, you don't get credit for that exit. Let's push it out and see what happens. But we're also looking at other metrics. So multiples of invested capital distributed to paid in. We then pick the vintage year. We don't let you pick it. So then we compare you to peers. I mean, we're doing all sorts of stuff. We're even analyzing it to see how you created value. I think that's important. So did it come from revenue growth? Did it come from profit margin enhancement? Did it come from multiple expansion? Or did it come from leverage effects? And so we want to see more actual durable, value creation. Okay. So that's where we'll spend our time in order to prioritize from what really looks like attractive performance to us that's replicable, process-oriented, and durable, and not merely or looks less like luck. We'll prioritize more work on that manager.
Mm. You mentioned credit facilities, and I think this has been a pretty big topic lately in the private equity world. If we step aside from your DD process, but if you look at the managers that you already invested in, how do you think about the use of credit facility, and how do you judge whether they're using it to game IRR or if they're really using it to better manage capital calls and distributions?
Right. So that's a tough question. And I would say, I think at this point, they're all using it to game IRR, and whether they tacitly acknowledge that or not, they all are. And I mean, most of our managers will admit to that, and they'll say we kind of have to because everyone else is. And so it's really understanding the extent to which they're doing that. And what we try to do is negotiate caps and limits around the use of those credit facilities. So we'll try to keep them shorter in duration. We'll try to limit them to a relatively smaller percentage of the fund. And we do want managers that, aren't just using it to juice returns completely, but will clean it up every couple of months. Mm-hmm. But the reality is that everyone is using it. I just saw some research that over the last 5 years, I think it's gone, I can't remember the exact numbers, but it's gone from basically no funds had it to all funds had it. And virtually the vast majority of deals are put on a credit facility at some point. Mm. So the industry has completely changed, and you just have to understand how it impacts the cash flows in the fund that you're in, and whether or not the gross returns still justify your fees. I mean, to be quite honest, we do have a manager who even told us, like, we're activating the fund. The first deal is going to go on the credit facility. It's a 1-year facility. And like they said, we're going to keep it there for 364 days. So I appreciate the transparency. They're honest about it. But I mean, that's the world that we're in today. I've heard some people criticize it completely as just a complete waste. I don't think that's entirely fair, because you do earn the levered return. And, hedge funds, most of them do not have gross leverage of 100. They're using leverage. Mm. We as an entity cannot use leverage on balance sheet by statute. And right. So in some ways, it's an effective and relatively low risk, and frankly, still relatively low cost added source of return.
Yeah. Very interesting. So I'm not very familiar with the involvement of consultants in such due diligence processes. So in what extent does Stepstone help you? Do they provide you reports of meetings that they've had with them? Do they actually meet with them in your behalf? How does that work?
So I'll say they are very helpful really at 2 points in that kind of funnel that I described. So as I mentioned, at the top of the funnel, the vast majority of our flow is coming from them. But as I said, we know a lot of placement agents. We've got big networks. We're in town. So we do see quite a bit. But they're very helpful with that quick initial prioritization of high quality managers and figuring out who should get a little bit more work at the top of the funnel. They do extensive diligence. So I'd say they've got a huge team. They've got huge resources around the globe. They're very strong. And yes, they're meeting with all these managers. They're doing deep dive due diligence. They have very robust performance analytics. They have their own engines and online tools for that. But we kind of triangulate, and they do their own work. We do our own work. And then when we get down to kind of the bottom of the funnel where we're going to move forward or likely going to move forward with someone, they have to do their own independent due diligence. And so they're doing their on-sites, their reference checks. They're going through all the data room, looking at the docs, et cetera. And they go through their investment committee entirely independently. And the deliverable to us is a actual due diligence report and then a memo to the board. And so again, they're very, very helpful in our board meetings, explaining to the trustees the work that we've done and they've done and why that this is a prudent investment for us. So like I said, we have it's a dual track process, entirely independent. So we're creating our own performance analytics package for every manager, our own due diligence packet, our own references. We create our own memo, and we have an internal investment committee that is composed of all the asset class directors and our CIO, and it goes through a full vote. And then after that, only when Stepstone and RIC are in agreement is a manager then brought to the board.
Has it happened a lot that you were not in agreement?
So because we have limited resources, we try not to spend time on managers that Stepstone has identified serious issues with that they're unlikely to sort of change their mind on or get comfortable with. And so those are going to get kicked out. If we get to the finish line and we both disagree, frankly, I've kind of failed in my job because I should have figured out ahead of time and either cleaned up the issues or discontinued due diligence. With 3 people in private equity, we don't have unlimited time to kind of dive deep on everybody. So I'd say there's been 1 or 2 where we get close to the finish line out of 40 line items, and we wind up disagreeing, and it'll kill it. But once we are in agreement and it goes to the board has been unanimous in supporting all of our recommendations, because really our job is to ensure that it's a very clean recommendation for them and there are no issues.
Okay. You mentioned references. This is also an interesting topic. People do it differently, but how do you think about it? How many is enough? And how do you prepare for it? What types of questions do you ask in order to try to squeeze out information that might not be, information that you actually can use?
Right. So, decision? Yeah, no, I mean, it's a good question. There's a couple of different approaches. I'll say, thinking about it initially, we don't do the same process necessarily for every single manager. We're going to prioritize in thinking of our people, process, portfolio, et cetera. When we have a lot of uncertainty around the team or a lot of business risk, say smaller manager team coming together, reference work is going to be much more important. And so we will not only emphasize it more, but we will do more of it. And so that might be 10 or 12 reference calls as opposed to 2 or 3 for a team that's on Fund 12 where there has been no turnover for a decade. Like a reference work there is just less relevant. And then the questions that we ask are going to be tilted towards the specific risks. And you brought up, you need to have targeted questions. You can sometimes get references who will just kind of, spill their guts to you on the phone and go through all their thesis, all their risks, et cetera. But more often than not, you have to be smart and kind of draw answers out of them. I'd say the last point kind of on references that we found is it's far more important to have off-sheet references than on-sheet. So the manager's going to give us, 4 pages of references. They're obviously curated to be really good, but we go to our network and get not just LPs or people who've, worked with them in the past that we know, but we'll try to find LPs who got close and didn't get there, right? Because we're trying to poke holes in the thesis, and those are the ones most likely to help us see risks that we didn't see.
Yeah, that's very interesting. Do you find that the effectiveness of these references change based on whether you're doing it on the phone or in person?
So we haven't done too many in person because, there's probably been a few here in town. I'm not, off the top of my head, I can't recall any, but there's probably been a few here in town where we just shared names with some of the other allocators. Vast majority of them are phone calls.
Okay, good. And in terms of your on-site, how does it look like? How much time do you spend on site? Is it one day or a week? Do you meet with every single person? What does that look like?
So again, it depends upon the specific risks of that manager that we're trying to underwrite. Again, the bigger the firm, the more stable the team, the longer the track record, the more consistent the process. All those things, suggest that it's less important to meet every individual. It's less important to focus on a few sort of operational issues. But broadly speaking, the on-sites can last from, 2.5 to kind of 4 hours. We may do only one. We do have a decent travel budget, but again, not unlimited. We may do 2. We may do even more. We've had some due diligence processes that have taken us sort of 2 to 3 years from when we first got to know the manager to when we closed on a fund. So sometimes we'll skip a fund and keep doing work and get to know them. And so there might be times where we have 4 or 5 on-sites before we commit. It's all about sort of addressing the issues and concerns that we have during the underwriting process. Generally speaking, we want to meet with as many members of the team as we can. We will lay out a formal agenda for each meeting, and it'll typically be to go over as many of individual line items as we can and get, complete transparency and clarity around those deals, and then use them as a way to really understand how the process works.
Okay. And in terms of internal decision making, does everyone get a vote, or do you have one person that makes the final call internally before it goes to the committee? Or
so the asset class directors bring it to the committee. We do kind of have a schedule over the year, like pacing models and how many deals are you bringing, and we have weekly meetings that are brief kind of update meetings. And so we're always informing kind of who's doing what deals are kind of coming so people can be prepared. But the monthly IC asset class directors bring the deal. All of the asset class directors have equal votes, except for the CIO. He's got sole veto, and then we just need a majority vote. But generally speaking, they're consensus.
Okay, interesting. Okay, well, this is a great overview of your whole process. Thank you for that. That's very helpful. And the reason why, if you remember, I contacted you was because of an article that you wrote on the CIO magazine, in which you talk about how you analyze a manager's psychological attributes.
Right.
It's called Psyching Out Money Managers, if I remember correctly. Can you talk about that? Just give an overview of what it is to the audience.
Sure. So hate to go back to the well once again, but I'm going to. We have the framework of the 5 Ps: people, philosophy, process, portfolio, performance. I sort of think all of them fall out of the previous one. So like the philosophy is kind of what the people think. The process is the implementation of the philosophy. The portfolio is the operationalization of the process, and portfolio is what drives performance. And so you kind of have to start with understanding the people to really understand what they're going to do, what they want to do. Past performance is not necessarily predictive of future performance, but past behavior is very indicative of future behavior. And we just have noticed over the years, I've taken probably 2,000 manager meetings in my career, you always just have this natural tendency to like people more after you meet them. And for the most part, you walk out of meetings going, they seem reasonable, or they seem smart, et cetera. And a big part of that underwriting process is evaluating the people, and it just seemed so subjective. So it dawned on me that we should do something there to try and make it less subjective, quantify it more, even if it's imperfectly. And I had taken a personality assessment during an interviewing process for an investment bank years ago and for a fund to fund. So I started to think about, should we do something in that space? And I read a Warren Buffett quote that
that said you should look for 3 qualities in hiring investment people: integrity, intelligence, and energy. If you don't have the first, the other 2 will kill you. And we had already thought that 3 I's were the most important characteristics of that first P. So the 3 I's are intensity, integrity, and intelligence, which pretty highly correlate to what Warren Buffett said. So it's like, can we quantify those 3 characteristics? Can we put a test in place where we can get an objective metric out of that rather than going, oh yeah, they seem good. And so we put a search together actually to go procure a vendor, looked at about 13 or 14 different tests and took them ourselves, had 4 or 5 people on a team here internally that were taking those tests and kind of sitting down to gauge their relevance and sort of accessibility. We ultimately picked one. And so now it's been about 3 years where we've been working with Profiles International to give a aptitude and personality assessment to all of our potential managers. And we've implemented it in private equity, private real assets, and real estate, and are investigating, could we use it elsewhere? It's been very helpful. I'm happy to kind of dive into some of the use cases and some of the things we've found.
Absolutely. That was my next question. So what have you found?
Well, what we found is it gives us deeper information than we would otherwise have, or I would say there are probably really deep dive diligence out there that comes to the same sort of conclusions, but it takes lots of time and you have to meet everybody multiple times. And so we're sort of getting the information objectively and quickly and efficiently. But what we do is we focus on kind of the key individuals. And so there's overlap between this and kind of the key person clause in the documents. We want to understand who are making decisions and how are they making them. And there's not necessarily a magic score, but we do want to see, are your scores kind of consistent with what you're telling us? And is that consistent with what your role should be? So what do I mean? Well, I think there's a couple of real clear examples that we've seen. If you're an underwriter at, say, a private credit fund, you may not score as high on the sociability spectrum, but you should be kind of process-oriented and you should score higher on the math aptitude. So that makes sense. Conversely, if you're the head of business development and you're, networking 250 days out of the year and you're at conferences trying to drum up business and meet executives, you should score higher on that sociability spectrum, and some of the other scores might not be as relevant. So we're looking for kind of a fit with the job and then overlap across some of those things on the team. And I think by and large, those scores have really made a lot of sense. The framework we're using is millions of people have taken this test and thousands of them from the financial services sector. And so we're benchmarking them against kind of senior executives in finance.
Okay, so a couple questions. Do you ask everyone in the team to take it or just the top management?
So there's a cost per test. So again, we have to be parsimonious with our resources. And I'd say we try to focus on the most critical decision makers at the firm. Like there's usually pretty tight overlap with the key person clause. And so if there's 4 people in the key person clause, there's 4 general partners of the firm. They have an investment committee and all 4 sit on the investment committee. That's a pretty clear case for us to do the test on all 4. But there are times where we've got to kind of decide. And I'd say some of the bigger funds, again, where they might have 6 senior partners and 5 or 6 junior partners, that would be prohibitively expensive for us to run it on all of them. And I don't think it's necessarily informative to do so. So we've got to kind of focus on understanding who really are sort of driving deals and who has like investment authority.
Okay. So in what stage of your process do you have them take it? Is it pretty advanced in the process already or quite late?
It's usually pretty advanced because there is a time requirement from the GP. I mean, it's about 45 minutes to an hour for them to do this test online. Now, they've all, by and large, been pretty receptive to it, but it usually is when we're close to getting there. I think it's probably less appropriate to do it if there's a high probability that they fall out of the process. So sometimes we've done it before and on site, and that in some ways is helpful because you do have their scores in front of you. And if they say, well, I'm the real decisive one and she's the really analytical one, well, we literally have that scored. So we know whether or not you're trying to sell us. But most of the time it's after the on-site, and then we will sit here and analyze the report and results afterwards.
So have you come across a situation in which you were quite advanced in your process and the score was the reason why you decided to decline?
So we have not had one instance where the score was the sole reason. There's been one where it factored into it. So back to the 3 I's, intensity, which is a combination of stuff on the personality side, intelligence, which is obviously the aptitude side. Integrity is a little tougher to score, but that's one that is kind of table stakes. It's a must-have.
Right.
So what our test does is it measures internal consistency, essentially trying to measure whether or not the candidate's gaming it. So think of it like this. It'll ask the same question multiple ways and answer yes to all of them. So do you like working individually? Yes or no. Do you like working on teams? Yes or no. Do you not like working individually? Yes or no, etc. Okay. People that are trying to sort of game the system will try to answer favorably in a lot of those cases. Yes, I like that. Yes, I like that. And that will come up as essentially being inconsistent or lying. So that would be a kind of a strong fail. We've had one where that score came up. And so we were pretty much already there, but that would have been a pass-fail situation.
And you mentioned that by and large, they are receptive to it. Is there any specific asset class or type of manager that is usually not as receptive to taking the test?
We found in private equity, we found that they have been, and many of these GPs are doing something similar when they hire portfolio company executives. So they're going to hire a CEO at a pretty healthy comp package. They're going to make sure they get the right guy or gal, and they're going to bring on an organizational psychologist to sit down and do an assessment. And so they sort of get it. They understand it. It's a 10-year lockup. And in PE and in drawdown vehicles, whether it be real estate, real assets, they've been accommodative. I think we haven't rolled it out aggressively in hedge funds. So this is not intended to be a blanket indictment, but we haven't had real luck there in the couple of cases where we've asked them to take it. They've declined. And I think there might be kind of a fundraising dynamic in play, having done hedge funds for a long time. They're sort of always in market, right? They're, with the rare exception of the true real hard closed funds, everybody's kind of open for the right money. And when they're hard closed, they're usually soft closed. And so there can be kind of we don't need to do that. Let's just keep the dialogue going. Whereas there's a discrete end to the fundraising period for private equity. So they know we get close to the finish line. If this is the last thing, it's relatively easy for them to do it. And then the fund lives. In hedge fund land, you can vote with your feet and kind of redeem, whereas here you're locked up. So I think for a couple of reasons, hedge fund managers just have less incentive to do it. And we kind of figured that. And so we haven't really aggressively pursued it.
And have you been able to find significant differences in the scores or in specific areas of the test in different asset classes? Let's say real estate managers score a certain way, private equity managers score a different way. Are there?
So there are a few interesting things. We've got about 115 responses. I think it's around 50 different general partners. So on average, 2 at each. This may sound kind of trite, but what we've noticed is that PE in general scores a little bit higher on mathematical competencies. Real estate, they're scoring much higher in sociability. And so there's some interesting trends there. One thing that we're working on right now, which is still too early to see if our kind of anecdotal experience will be borne out by the data. But I mentioned that value creation approach we take to analyzing performance. We look to see if you've driven revenue growth, have you driven in earnings improvement, have you driven value creation purely from selling at a higher multiple, and did you have the net debt pay down sort of effect, or did you lever up? We're starting to see, and again, it's purely anecdotal, but we're starting to see differences in the interest section that may correlate to that. And the interest section is what types of activities interest this individual. So growing up here in the States, we took standardized tests in high school, and they said at the bottom, like, you would like science or you would like math. Well, this test looks at a number of different areas of interest: creative, mechanical, enterprising, financial, administrative, people service, entrepreneurial, etc. And then it ranks the candidates by their top 3. we're starting to see some interesting trends there. In venture, this shouldn't be a surprise, but the top interest of everybody in venture is creative and technical. At buyout end of the spectrum, people have much more frequent scores in finance, administrative, and entrepreneurialism or enterprising. So our theory is that you can sort of see what they want to do there, and does that correlate to ways they create value? So I'd posit that, right, this creative, technical stuff, that you're creating a market, your value driver is going to be completely revenue growth. Now, as you move kind of more into growth strategies, you see, you might see enterprising or entrepreneurship and creative or technical. And so they're going to be scaling a business, which is growing revenue still strongly, but then also starting to turn that into an EBITDA profit business model. Whereas at the other end of the spectrum, and not just to pick on buyout in general, but or large buyout, but you tend to see more value creation coming from, multiple arbitrage, and they use leverage. And so you see more of a leverage effect. And there in buyout, they tend to score higher on financial administrative. And so we're looking for drivers of return that we think are durable and predictable. Financial engineering maybe necessarily isn't, but building businesses and growing them are. And we want to see managers who actually engaged in doing what they want to do. So that's one interesting thing. We're going to try to compile more data around that and see if it's an actual effect.
I'm assuming you look at managers all over the world, and there are certainly cultural differences between them. Does a test account for cultural differences at all?
So it's a better fit for domestic managers, and our portfolio today is heavily domestic focused. We're 85% U.S. or North America, with only a little bit in developed Europe. So there are some cultural biases built into it, and as we roll out a more global portfolio, we'll have to consider, is there a different test that we should implement where? But that's perhaps a little bit down the road. We're still kind of building, and we've been slow to kind of go international just in general. So a little bit of international exposure in real assets and a little bit of emerging markets exposure in sort of public markets, but PE not so much. Certainly it's a issue that we need to consider. We've actually encountered one particular candidate that was a foreign national whose scores were difficult to interpret, and we basically threw it out because we figured it was all a cultural effect.
Okay, so I mean, you've been doing this for 3 years now. You've had 115 responses. I'm assuming that the predictive power of the tool is not as strong yet because you're still early in the cycle, especially if you're talking about private equity managers. But what's the grand plan for this in 10 years? What is it that you'd like to get out of this?
Well, that's the ultimate holy grail. I mean, it's seeing if there are personality characteristics or clusters of characteristics or a link between aptitude and subsequent performance. I mean, these are things that are knowable in advance, where you're accessing that information doing due diligence, and then you subsequently measure performance coming afterwards. And so that would be like I said, that would be the holy grail. If we can find things ahead of time that predict performance, we can tilt there, and we would have an informational edge on the market. Now, we're not there yet. We do need to see more performance, so it takes longer to develop, and we want to build up a bigger database. But that would be very relevant and actionable data for us. So today, we're using it to understand just the team better, and we get to ask smarter questions. I'll say, kind of going back to like sociabilities. Let's say we have two partners, and they both kind of share business development. So called a small market buyout fund. They share business development responsibilities. They share deal responsibilities, et cetera. And looking at their scores, there's some overlap. There's some complementary scores, but they both score very low on sociability. Well, now we have a really targeted question around how do they manage that business development process? How do they source? How do they find fundraising? I mean, how do they find executives for the portfolio? And in the case where that this actually occurred, they immediately acknowledged that, yes, that's our biggest weakness. And so here's how we systematize that to ensure that we're doing it consistently. And here's how we put process around it. And so I think maybe not a slam dunk, but it certainly allows us to ask really smart questions that we wouldn't otherwise be able to do. And we'll see if there's something more there as we build it.
That's great. Did you receive a lot of responses from maybe other asset allocators who read your article with interest in such a tool, or have you seen other investors using a similar approach?
So we haven't seen too many allocators doing it. There are asset owners, certainly, who use it to hire people to come manage risk for them, whether it be multi-strategy hedge funds, long-only shops. A lot of PMs have done similar things. We did hear from a couple of fund-to-funds that were doing something similar. There was a hedge fund-to-fund that actually wound down a couple of years ago. They had a behavioral psychologist doing some similar stuff. And there is a sort of startup, I don't know if they've gotten any traction, but consulting firm in London that's looking to help allocators implement something similar. And so we have gotten some traction. We have had other people reach out and try to talk about it. And I think there might have even been a few who have gone so far as to speak to our vendor, but I'm not aware of anybody else kind of rolling it out broadly.
Very, very interesting. I want to take the last few minutes that we have together and ask you a few questions about your role as an allocator. And for those who are listening, what is it that they should try to do to get to that level? First, I wanted to ask you, what is it that you think are characteristics that people who want to get into the investment management business and the asset allocation world need to have to be able to succeed or to strive as you have?
So my top areas of interest on my test are creative, technical, and finance. Okay. So what I found to be helpful for my role is kind of this intellectual curiosity to want to learn and figure out what works for different strategies. I kind of liken it to the coach versus the player. I know I'm never going to run a buyout fund or a long-short equity fund, so I'm not the player, but you don't necessarily have to have been a player to be a good coach. Some of the best coaches never played professionally. You need to understand what matters and how to manage the processes, and so that requires some, digging like an investigative reporter. So intellectual curiosity around that is really important. I'd say there's a big difference between being the asset manager and being the asset owner in terms of pace. If you want immediate feedback and immediate gratification and you're better working in short-term kind of quick-hitting functions, maybe an asset owner is not the best place to be because it's all project-oriented and it takes, 4, 5, 6 years, 10 years in some cases to kind of really see the impact from your efforts.
Isn't it frustrating, though? The feedback loop from your experiencing in investing in private managers is right. So long that there is a limited amount that you can learn every time you make a new investment.
Right. So you can't train your own system one processing, your own short-term intuitive thinking based upon that feedback loop because it's too long. So when you train system one effectively, what do you need? You need tons of repetition, you need easily measurable outcomes, and you need immediate feedback. Well, you don't have that immediate feedback. So you've got to be willing to acquire high quality knowledge through other channels than your own personal experience. And that means reading, research, look at academia, look at what other people have done effectively, and figure out what works for those strategies. And so there is value in still turning over lots of stones. And so, like I said, we meet tons and tons of managers, but we're also always researching and consuming, industry and academic reports on what works here, what doesn't work here, how do you build this portfolio, et cetera.
Yeah, very interesting. I think it was maybe your CIO wrote in an article, said that Schelling is the kind of guy who reads white papers on weekends and loves to come up with new ways of looking at things. I think we can attest to that. Yeah, so is that what you do? You pick a white paper every evening and print it out and take it home with you and read it on your bed before you fall asleep? Or what's your approach?
As depressing as that sounds when you put it that way, that's not that far off from the truth. No, I've got a stack right on my desk right in front of me. We've got Till Death or Divorce Do Us Part, Early Life, Family Disruption, and Fund Manager Behavior, reading about global factor premiums. So yeah, I think that's a big part of, here's another one, talent versus luck, the role of randomness in success and failure. So I do think that sort of intellectual curiosity, trying to figure out how to make stuff better. I had a fund manager put it to me this way, and it stuck with me. This was some time ago. I am market efficiency, and that's true,
but another one said, I've got to get better faster than the market does.
Mm-hmm.
That's what alpha is. I've got to get better faster than the market does. And so we keep trying to refine our processes and add stuff where we can add stuff. If we can get an informational edge, like our personality profiles, we're going to try to do that.
Mm-hmm. In terms of reading, you mentioned white papers, and I'm always curious to hear about how other investors get their information. So how do you separate signal from noise? Where do you find quality information? How do you sort through that?
So there's different sources for different types of information. I've got a lot of newsletters for private equity news and pension news specifically. So that might be, for Private Equity International, Private Equity Professional, PE Hub, etc. For pensions here in the States, we're looking at P&I Online, Institutional Investor, CIO Magazine, things like that. But those are more news kind of focused. I don't spend as much time in capital markets research on a day-to-day basis as our public markets people will, because obviously it's more relevant for them. And so I'm looking at longer picture trends in terms of valuation and credit market stuff. And I will read just broader finance news, whether it be Bloomberg or CNN, Money, it's Reuters, etc.
Mm-hmm. But
that's all very quick stuff. As far as really spending my time, most of it is on structural things that I can implement for long-term value creation. So that's a lot of academic white papers. I mean, I'm a user of the SSRN, Social Science Research Network. A lot of big, Harvard Business School publishes a lot of great stuff. EdHec in France they publish a ton of stuff. And so finding a couple of academic think tanks, the Hoover Institute, Rotman Institute in Toronto, that are public pension and kind of private equity alternatives focused is important. The last kind of ones I think are more relevant, like the Kaya Association. They have a couple of journals that they publish and newsletters that are very helpful. So think of that.
Do you read annual reports from university endowments?
Upon occasion, we'll look through them. Mm-hmm. I'd say like the newsletter, the comments that come out of MIT, those are extraordinarily valuable. And so that's one that we do read, but not everyone certainly cover to cover. And
Right, absolutely. And one last question, and I might know the answer to this based on your comments earlier. Do you think someone in your role needs to have had a direct experience or not?
So I think it certainly makes you more knowledgeable at a specific strategy, and you can be great, but I don't think it's required. I think, being a good allocator means you have to be a good allocator, not a good asset selector necessarily. And so I think when you look at some of the greater allocators, not all of them have come from, portfolio manager or trader's background. I've found there's also kind of a perverse and somewhat, flip side to that, where I've worked with diligence professionals that had, traded currency on bank desk and done stuff like that. There's a bias that you bring, like, well, this is how we did it. And that's not always helpful. So there's pros and cons to it. I mean, it's always good to have managed risk and think like a principal investor, but you can still get that as an allocator. So,
Very interesting. Chris, well, thank you very much for taking the time to speak to us. I've learned a ton, and I hope that everyone who's listening, who is interested in this topic, of course, has learned a lot as well. I know that you publish a lot of information on Institutional Investor and on LinkedIn as well. Are there any other venues where people can find out more about you and what you're up to?
No, those are the two main ones. I try to write a monthly column for Institutional Investor. I've been fortunate enough to have the forum to just kind of talk about what I like. As you can tell, I can talk a lot about it if I like it, and they've been great. And so, yeah, the monthly dynamic allocator column is mine, but it's usually posted on LinkedIn.
Yeah, great. Well, it's clear that you enjoy this, and maybe we'll do a round 2 a few years from today. It's been a true pleasure, Chris, so thank you.
Well, thanks for having me, Leo. Appreciate it.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products, and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.